I'm David Scranton, and thanks for clicking this video. Today we're talking about successful investing tips. And we want to bring in our guest, Eddie Ghabour, co-owner of Key Advisors Group in Delaware. Eddie is also the Amazon best-selling author of the book, The Common Sense Bull. Eddie, it's always great to have you back on the show. You never fail to give us words of wisdom that are absolutely incredible. Thank you.
Thank you, Dave. I really appreciate you allowing me on your show.
So allowing you, I feel privileged. You kidding me? So, okay, we're talking today about how investing is simple, but not easy. So give me some examples of where you think that particularly holds true and why.
So I think when it comes to investing, I think one of the most difficult things for everyday investors to do, which is why I've always been a big believer in having a coach to help guide you through, is really the decision-making process, as well as putting your blinders on in regards to what that news or hot topic of the day is. Because it's been too often, I know you've seen it in your career, where investors will make an emotional decision on their investment portfolio based on what that news is today. And ultimately, many times that ends up being the wrong decision because it's based on emotion and not fundamentals.
Yeah, trading the headlines is usually a mistake. And we're talking about the emotions a lot today. So, how do you coach your clients then to try to put the emotions aside and make good, rational decisions?
Well, it's very difficult. I feel like we're more educators than anything.
Sure.
When we meet with clients, we really try to continue to educate them each time. But Dave, I'll tell you, one of the biggest things that we tell people is one way to make sure you don't make a bad decision emotionally is don't put yourself in a position where you can lose a lot of money. No one makes an emotional decision when they're making money. It's usually when the account's losing value. So if you focus on risk management and try to protect downside as much as you possibly can, chances of you making an emotional decision when things are going bad are minimized drastically because you're not taking the huge hit that gambler is taking in regards to their portfolio.
Mm-hmm. Sure. Yeah. And now, we've got all kinds of headline things. We've got, the market's done great for over a year now. And, we got right now the resurgence of the Taliban, which I'm sure is a big headline concern as we're approaching the 20th anniversary of 9/11. And we have, these variants of COVID, which threaten to kind of informally, if not formally, shut down parts of the economy again. But do you think those are headlines that are real, that people should pay attention to? Or do you think that the momentum in the market is still strong, that it can last for another 6 or 12 months?
So I think that we still have a little bit of runway for about 6 more months. Delta doesn't concern me because if you look at other countries, they hit peak at about 45 days of the surge, and then it really dropped drastically. I think the biggest short-term surprise could really come from the Fed tapering sooner than many people anticipate. But ultimately, I think this year, when we hit September, we could see a nice run up in the markets because they've been flat for several weeks. But I am very, very concerned about next year, especially as we look at the second quarter next year. We are going to be in a slower growing economy. We have inflation that's going to be sticky. I don't agree with that it's transitory. And so with the comps on the second quarter next year versus second quarter this year are not even going to be close. So we are going to start playing real defense as we go into the next year.
Okay. All right. So no need to panic right away, but start to get postured for defense. Got it. Now, okay, you're investing in stocks, and I know you're a fan of dividend-based stock strategies. And you just heard John Najarian talk about how sometimes dividend-based or value-based stock investing is a lot harder than momentum, which is why he and his brother love to do momentum trading. In your own words, we talk about all the time on the show, but in your own words, why is that value dividend investing so much harder than growth investing in the stock market?
Well, I think you have to have a little bit more detail and research behind making those decisions. Sometimes investors will just look at the yield and make their decision just solely based on that. Where you really need to know, if the yield is too high and it sounds too good to be true, it's probably because the company has some credit risk potentially. So you not only need to look at the company itself, you need to look at its ability to continue to pay that dividend. We like companies that have a history of increasing their dividend for clients as an inflation hedge. But then you also need to look at the sector too, right? You want to make sure that you're not just buying something just for the dividend, because if it's going to lose 15% of its value, then, you kind of put yourself in a wrong position there. So there's a lot more that goes into it versus riding the short-term momentum plays. And Dave, you know that better than anybody. When you're designing portfolios for clients, there's a lot of critical things you need to make sure you get right before you can really jump in and buy that asset.
Yeah, I mean, you lose 15%, and that's what, 3-4 years worth of dividend gone right there. And oftentimes, companies can cut dividends. So you've got to be careful. Like we always talk about, Eddie, high dividend payers are usually in the mature stage of the corporate life cycle. The question is, are they at the beginning of the mature stage where they still have some growth potential, or are they at the ending of the mature stage where they're likely to become somewhat insignificant over time? So, Eddie, as usual, it's our pleasure. Thank you so much for being back with us on the show. And hey, we look forward to having you back.
Thank you, Dave.
And a big thanks to you for watching. If you enjoyed this interview, make sure you give it a thumbs up and you subscribe to our YouTube channel for new content each and every week.